telling people, hold on, I think in the next 6 months, suddenly this economy is just going to fall apart and nobody's going to know why. You know what I call it? The exhaustion of demand. The next few years is going to be what 2020 to 22 should have been, the tail end of a longer downturn and depression like 1930 to 42, which should have happened 2008 to 22, 23. The biggest mistake economists make, because they never had sex and run a business and don't understand reality of the economy, is to think that recessions are the enemy. That's like a doctor telling me, Harry, what are you doing sleeping 6 to 8 hours a week? There's one investment that's already been proven when you have a strong deflationary downturn like 2008 to 9, already proven, even though they cut that short. But when does it burst? Because it keeps going. Well, 525 basis points say the highest probability of this thing bursting is over the next year. If it doesn't burst in the next year, I'm just going to shut up and go hide in the woods down here in Puerto Rico.
Hey guys, welcome back to Capital Cosm. Today I am with the legendary Harry Dent. Harry, thank you so much for coming on, my friend.
Yeah, nice to be here, Danny.
As always, Harry, for my first-time guests that are, making their maiden voyage onto the show, of course, everyone knows who Harry Dent is for the most part. You've been on YouTube for decades. But I'd like to kind of get your origin story. How did you arrive to where you're at today?
Well, I went to University of South Carolina, and my father was in politics, but I had a lot of rich business friends, and they said, hey, Harry, get your accounting and finance. That's the stuff we wish we had taken, because I wanted to go to Harvard Business School or Stanford Business Schools. They said, no, do that first, and then take that stuff there. So I did that, and I got stellar grades because I knew how hard it was to get into Harvard Business School. And I got in by the hair of my chinny chin chin. It's very hard. The hardest thing is getting in there. And I was going to be a corporate, top manager, something like that. Well, nothing could have been farther than the truth. It took me years to realize I was an entrepreneur and not a manager or a corporate manager, to say the least, Fortune 100 sort of stuff. So yeah, I worked for a Fortune 100 company for 2 years, worked at Bain & Company, super consulting company, for a year and a half, and then ended up taking a job to turn around a publishing company in California through a friend, and just said, oh man, this is my thing. New ventures, I realized, that's my people. I'm an entrepreneur, and I was particularly good at turning around companies in trouble. And of course, new ventures are always in trouble. The failure rate is like astronomical. It took me a long time to learn that one too, because I invested in a lot of new ventures in the 80s and lost on most of them, as everybody does. It's very, very risky. So I just, I got all the hard stuff down. I really was focused on business strategy and economics, and I was going to major in economics in college, and after the third course, I'm like, this is boring and conceptual. It's useless. So I gave up on economics, and while I was consulting and turning around companies in California, new ventures, which was on the leading edge. I got into more, okay, what are the new technologies? I started to see the new economy rather than the old. And I just naturally, I did research on the side and came up with my own economic theory. I realized, no, my first love was economics. Economics was boring. So I studied thousands of years of history, all the way back to the agricultural revolution. So 10,000 years to be exact, all of modern history, in depth, went through 10,000 pages, pretty much in depth without reading every word. And basically started to realize, okay, here's the cycles that matter. Here's the things that matter in history. And again, just came up with my own theory of economics, which a big part of it, people call me the demographics guy. That's just a big piece. I stumbled on what I call the spending wave, which I came a simple indicator, lagged forward the birth index, which I have to adjust for immigrants. That's the hard part. The birth index is easy to get in the US or any major country. Adjust for immigrants because they're real people too, and move it forward for something I could determine was real, the peak in spending of the average household at age 46, moving towards 47, and between that and most developed country in the world. So I can look at any major country in the world, lag forward that immigration adjusted birth index, and say this is when they're going to grow and when they're not. And of course, the first thing I saw, Danny, right back then in the early mid 80s, oh my gosh, this boom that had just started. We'd been in the long inflationary, off and on recession for 12, 14 years. Everybody thought the US was toast and never going to be a great country again. And I'm saying, no, our baby boom is going to make us the greatest country in the world again, because we got the biggest one in the world and the most affluent and most innovative. We still lead innovation. And so that's how I got going with books and speaking, a whole new career instead of business consulting. And of course, I've been doing that ever since. And my newsletter is the main thing I do now, monthly newsletter, HS Dent Forecast. You can get that at harrydent.com. You can get on my free newsletter to warm me up for my paid one. And that's what I love. I work out of my home in Puerto Rico with an ocean view in a house that I would have never bought in Florida, or if I had still been in California with this housing bubble. But things are different here, and I got a great deal and stuff. So I'm very happy in Puerto Rico, and I just do my research and then occasionally travel out and speak and do stuff. But I don't speak nearly as much. The reason I could move to Puerto Rico was I got out of the speaking thing. Constantly traveling, which I did in the '90s and early 2000s, was not a fun life.
Yeah, yeah. I mean, one of the things obviously is your demographic analysis. That's a big part of your economic analysis. So I want to ask you, what about the millennial cohort? Isn't the millennial cohort just as big, if not slightly bigger, than the boomer generation?
Yeah, Dave, that's a great question, because this is very misunderstood. Yes, they are a larger generation in numbers. Okay, their whole birth thing was drawn over a longer period of time. But what I see, and being an ex bad surfer, waves are what matter. And the baby boom was the biggest wave, much larger, 3 times the wave. It's like a 10-foot wave on the beach instead of a 3-foot wave. And a surfer knows the difference. That one will kill you, one of them won't. Okay, that big a difference. And so the baby boom was this huge wave. The millennial, after the baby bust, from 62 into 76 or so, the millennials came from 1977 on into 2007. That was their boom. It's not as steep, and so it is a bigger generation, but they start from higher levels, and we will not see in the United States a boom as extreme as 1983 to 2007. That's what I got. It was in the early to mid 80s, and only small business CEOs would listen to me then, not mainstream economists, not mainstream companies and stuff. I was saying this is going to be the greatest boom in history, just when people think Japan's taking over in East Asia and we're has-beens as the U.S. I said, we have the best baby boom in the world. Europe's got a strong one too, but we have the best. And Japan is basically going to go down, not take us over, because their baby boom was already peaking in the 90s, and has done nothing but go down since. And China's the same today. Everybody's like, well, China's going to take over the world. Well, guess who's got as bad a demographics as Japan on a lag? China and South Korea, all in East Asia. So demographics is destiny, but I also came up with a geopolitical cycle that ebbs and flows, about 18 years positive and 17, 18 negative, and we're in the positive side of that one. But these demographic cycles, there's also a 45-year technology innovation cycle, and that is what kept us going after the 2007 baby boom peak. But that cycle has turned down in the early 2020s here, and that's what all this stimulus is about. First, the demographic cycle turns down, 2008 forward. Now the technology cycle peaks in around late 2019, early 2020, right around COVID, and everybody's blaming all this stuff on COVID. No, we would be seeing a natural downturn on this other big technology cycle anyway. So those are the 3 big cycles. And I'm telling you, Danny, I tell people think it's crazy to say this, especially in economics, when nobody thinks you can predict past the next election. I I would rather tell you what's going to happen 10, 20, 30, 40 years out in a reasonable range than next year or two, because in politics, a lot of things can change short term, and the long term is already set in stone. Again, people thought U.S. was a has-been. Japan and East Asia were going to take over the world. The opposite happened. We resurged stronger than ever, and Japan was the one that went down. Simple 46, 47-year lag on the birth index was able to predict that. One of the simplest economic indicators in history, and I still can't get mainstream economists to think that's important. They think, oh, monetary policy and fiscal policy, that stuff doesn't change that much. No president changes stuff that much unless they come into a crisis. And I always love Bill Clinton for saying, I never had a great enough crisis to go down as the great president, and he didn't. He walked into the 90s, the best decade, better than the roaring 20s, again, because of the baby boom in its prime there, and the technology cycle as well at the same time. That was the best decade in U.S. history. And so, of course, he was popular. He was a good president. But yes, he's not going to go down like Lincoln or Washington or FDR, who managed the great, the Great Depression economy. He's not going to go down as one of the great presidents. He was right about that. I'll tell you who is the next president. I think we are now, they tried to blow our way out of this 2008-9 recession with the biggest stimulus program. Again, $27 trillion, 1.5 times our entire GDP over the last many years. That went into 19 trillion, went into massive deficit straight in the economy, and 8 trillion went straight into the financial asset markets, monetary injections. That's what they do. They buy their own treasury bonds, and that adds more money to the pool chasing financial assets. And in addition to the fiscal stimulus, stepping up the economy and trying to make up for the baby bust, this monetary stimulus also increases the valuations on stocks and all financial assets, especially real estate. So that's what we're at. We've had what I call a big, fat, fake, artificial boom since 2008. And I think now that they overreacted to COVID, they were just keeping this thing going, until they overreacted to COVID, which is a short-term crisis, and nobody's going to blame the economy for that, or economists or anybody. 11 trillion of this 27 came in 2 years after COVID. Okay, that created that 9% inflation when we'd already gotten back down to 1 to 2 and continue going to be low. I mean, I've been forecasting this along with the great boom. I also said inflation will go down to near zero. The productivity of the generation not only creates higher spending but lower inflation. So all these things predictable, but the government really changed things with this 27 trillion in stimulus. And now we have to see what happens now that they've raised interest rates 525 basis points, biggest since 1981, which caused the biggest downturn since the Great Depression back then. How does this impact the economy? And I'm telling people, hold on, I think in the next 6 months, suddenly this economy is just going to fall apart and nobody's going to know why. You know what I call it? The exhaustion of demand. Okay. They've just pushed consumers, lower rates, all these things, stimulus, push them to spend how many times can you trade up to a bigger home? Only once, maybe twice. Okay. We're running out of things we can do. And now they've had to tighten from their own excesses. And I think the next few years is going to be what 2020 to 22 should have been, the tail end of a longer downturn and depression like 1930 to 42, which should have happened 2008 to 22, 23. So we blew our way out of we had 2008, 9, and frankly, that should have gone a year longer and been deeper. And then we should have had another downturn, kind of like 1937 to 38, following the Great Depression, 2020 to 22. Then we would have been over this. We would have purged all the bad debts and zombie companies that always come in booms. That's why we have recessions. The biggest mistake economists make, because they've never had sex and run a business and don't understand reality of the economy, is to think that recessions are the enemy. That's like a doctor telling me, Harry, what are you doing sleeping 6 to 8 hours a week? You're wasting time.
It's a
Take
cleanse.
some no-dos
It's a
and keep
cleanse.
working. What's wrong with you? Sleep is as necessary to us staying productive and waking as is recessions. And it's the same ratio 70% boom, 30% bust over history. And economists are mistakenly trying to annihilate recessions. My motto is if you don't want to have bad recession, don't have a bubbly, crazy boom. But you have to have recessions and slowdowns and generation cycles. Births go up and down, technology surge and then peak. They accelerate from 10 to 90% on an S curve, and then they slow down. And then the next ones incubate, and then they surge 10 to 90. So you have S curves of technologies and generational surges in spending all throughout history. I can map those out and tell your kids what the economy is going to look like in 2065 when they're at the top of their spending cycle in life. Today, because it's that predictable, and economists don't think we can predict anything past the next election. I am in more question with all this overstimulus and now over tightening, what the hell is going to happen in the next year or two and into this election?
Yeah, yeah. I mean, as unsavory as it may sound, however, I mean, they've made us kick this can down the road, a lot further than a lot of us have expected. So,
Way further, yes.
Is there the probability? Is there the chance that they can kick it even further? I mean, you did mention a 6 month time frame, but is there a chance that they could even prolong the day of reckoning further out?
Yes, there is. The problem is that lag. Number one, I mentioned a year and a half, and it's at least a year and a half now. I think the magnitude of stimulus has made a lag. There used to be a year and a half, probably more like a year and a half to two. I mean, when you're talking $27 trillion in stimulus and 11 trillion of it just in the last few years, it takes longer for the economy to digest that. So they've already tightened the most in 40 years, okay? And that's going to hit the most into early to mid next year. We have not felt it yet. People know about the lag, but they don't think about it. They don't put it into print. We're going to feel this the most. We are not going to know how much this stimulus hits until the first quarter of next year. And I think we're going to be in a recession by then. And they're going to do a little quarter basis point drawback after 525, okay? A quarter point. What difference is that going to make, Danny? Almost nothing. It at least shows change in direction. But they don't do that till late September. And then by December, maybe they go another 50 or 75 mil. That's still not even bringing us back to neutral when we probably have the biggest recession ahead of us. Why? Recessions happen every decade. Now it's been 15 years since the last recession, the longest in all of American and modern history. And I'm telling you, I bet my whole career on this, no way we have a soft landing after 15 years without a recession and all these bad debts go. We're not having to face the bad debts because the economists and Federal Reserve and central banks around the world won't let the economy take a break, which then flushes out these zombie companies and bad debts and makes us healthy again. It's a good thing to have this happen once a decade. And to think, as I said earlier, we can have booms without bust is the most naive thing in economics today. Shame on economists. And I'm not surprised because, again, I ask people, look at mainstream economists. Do any of them show me one that looks like they've ever had sex or run a business? And I'll tell you, no way in hell have they ever run a business, anyone I've met. So how are you going to really understand? I ran 8 businesses. I was CEO of 8 businesses in the 80s in turnarounds where when you can make 5 times the change. That's what I learned. I realized, oh my gosh, crises are great for a guy like me that likes to make change. I can make much more change in 6 months to a year and a half in a company when they're in a crisis than when they're just sailing along because people are resistant to change naturally. Okay. I'm a change guy. I'm a progress guy. So I love the 80s. I could turn around businesses in distress. But I saw that there's a benefit. You don't always have a boom for a reason. We don't always stay awake for a reason. There's not dark and light. There's both for a reason. Play of opposites is the very battery and energy that drives everything. And there's inflation and deflation. People, oh, we can't have more than 2% inflation. No, let the damn economy decide how much inflation. Inflation is how the economy raises a lot of money short term to invest in new technologies when the old ones are maturing and failing. Let the economy do what it does. It's called free market capitalism. It's made us the richest over the last 200 years in all of human history for 3,000 years put together, more progress. And they want to go now do top down government capitalism. Yeah, this is ridiculous. These people ought to be put in jail. I put them in jail. This is terrible to basically take the greatest success in history and say, well, now that we're spoiled and rich, we don't want to have one of these petty recessions. Recessions are the most important thing that happen. The booms and innovations come out of it. People don't innovate when things are good. They innovate when they're getting their ass kicked. That's what I learned in the 80s, turning around failing small businesses. Leading innovators in our economy, I learned about innovation, where it comes from, and I learned that it doesn't happen without challenge. It doesn't happen when everybody's fat and happy, and we never have a recession.
Fear is the greatest motivator. And I mean, what
Yeah.
you were just alluding to, I mean, you can essentially boil it down to mean reversion. And with mean reversion, we always overshoot on the upside and overshoot on the downside. And
And again, people want to blend that out. You get immediate if you smash that down, you get a mediocre, lower innovation economy. It is the extremes of ups and downs that stimulates this stronger innovation. Everything comes from innovation, including the innovation of people having young kids pop out. Okay, that's the biggest innovation people do, and we've been having less kids forever too. And if it weren't for our strong immigration in countries like Australia, that I speak in a lot, even stronger, all developed countries are basically slowing and will slow more, as Japan has been the first to prove, and China is the first emerging country to show that slowing. The demographics are their population in the next 50 years, Danny, is already set to go from 1.4 trillion to 780 million, cut 40% over the next 50 years.
mm-hmm.
And everybody thinks China's going to grow and take over the world. They're going to be the fastest failing country like Japan on a 2-decade, 3-decade lag.
And isn't that an artifact of central planning due to their one-child policy?
Exactly. They decided, oh, we got too many people, we got to restrict births. And now that they've told people they can have 2 or 3, guess what? People realize, oh my gosh, we're richer when we have 1 kid than we have 2 or 3. That the Chinese aren't having more babies even now that they've let it off, because they realize it's more economic to have 1 kid and get them into Harvard or Stanford. That's the Chinese dream. Have 1 kid, spoil the hell out of them, and get them into the best schools you can get them into. And you can't do that with 3 or 4 kids very easily, especially on their average income of 12 to 19,000 US dollars.
So why is it in the United States and Canada and Europe you're not seeing this big push to reproduce like you are in, say, Japan? Like the Japanese government is essentially begging their people to reproduce.
Yeah,
you don't see that here. Why is that?
Yeah, only because they let it happen for so long. They didn't see it happen coming for a long time. They didn't worry about it for a long time. They're worrying about it because they're going to shrink into nothing. They're the fastest shrinking country in the world. South Korea and China are number 2 and 3. Okay, so again, this is something you can see coming, and so we should see it coming. Anybody should see it coming. Emerging countries, as they get fully urban, and the biggest way, Danny, in history you get rich, and the problem is the developed countries have already done this, so we have to do it through technologies and productivity. The best way is just moving people from rural to urban areas where there's greater specialization of labor and much higher paying jobs. But it's specialization that makes people, the same everyday person with the same brain and intelligence, when they focus on what they do best and specialize more, becomes massively more productive. Specialization of labor, if I had to say, is the number 1 principle long-term in economics. And all of this globalization and new technologies have only allowed us to leverage that more and specialize people more. And that's how we get rich. And how we don't get rich is stimulating our economy, never having to innovate, never be challenged, and encouraging people to retire. at age 62 to 65, when now somebody who makes it to that age, forget average life expectancy, 77 for men, 80, 81 for women in the US. Once you reach 65 retirement age, you're already going to live longer because the longer you live, the longer you live, because a lot of those averages are having people that die all over their lifespan for accidents and all other types of reasons and
Mm-hmm.
diseases and stuff. It's just, you have to keep people innovating. And yes, we have to encourage births. And the U.S. is becoming increasingly anti-immigrant. That is our strong suit. Everybody in the world wants to move here. And I tell you, if I could live anywhere in the world, I would move from here to Australia. They have stronger, higher quality immigration, stronger growth, great climate. All of Australia is like California to me, and stuff. And that's what happens. You need mobility, new technologies allowed to flourish, people allowed to move and migrate. The more you try to lock down nirvana and create heaven on earth, the more you kill the golden goose. And we're doing that. From my point of view, free market capitalism died in the developed world in 2008 and is yet to be revived. We will sooner or later, because if we'll get enough pain, we'll say, oh, yes, that's right. We killed free market capitalism. Maybe that's what we did wrong. That's what we've done wrong. The United States still has strong immigration and can still grow, not as strong as Australia, but can still grow fairly strongly if we get out of this anti-capitalism, anti-free market capitalism, and say we can never have a recession. It's too much painful. No pain, no gain. Maybe number one principle in all of history. No pain, no gain.
How do you deal with the sovereign debt crisis, though, with the $35 trillion debt overhang and the debt on the entitlements as well?
Yeah. Well, you know what? You can't do much about the sovereign debt, but the sovereign debt is only less than a third of the total debt. Private debt will restructure at the speed of light if we have a strong enough downturn. That's the secret. It's the private debt that grows the most in a boom. The government benefits from the higher tax revenues and all that sort of stuff, okay, for doing nothing different, okay? Businesses have to grow and invest. And then when things go down, they cut, like I did. I was a turnaround manager. I can cut. The key is overheads, okay? Overheads are often 50% of expenditures, and you can cut them 30% in a blink, and 50% if you really dig down in a crisis. And I've done that over and over again. People say, "Oh, you can't cut that. It's fixed." No, it's not fixed. It's fixed only in a short time frame. That's where the benefits are. So in a downturn, businesses cut back. The weak businesses go under, and usually they don't totally disappear. They get absorbed by a stronger business, which makes that stronger business stronger. So recessions and downturns make the strong stronger, weed out the weak, weed out waste, zombie companies, bad debts. Our problem is we take on debts and nobody wants to write them off. They only write them off if we have to. Being forced to write down debts, and that's what happens. Our private debt, which is about 70% of our total debt, could be cut in half, okay, in the right economy. And that's where and when that happens, the economy turns around and grows again, and then the government benefits from that. And if they don't keep taking on more expenditures, which they don't need to, then their debt ratios go down as well. But government is the place that you can't cut as easily. Yes, they can cut some expenses, but the government won't do it. I mean, and when you go into a downturn, everybody almost looks. It's Keynesian theory, and I hate John Maynard Keynes. He's the problem. He was the worst innovation in history. He's the one that came up with, well, the economy's slowing, just print money and make it grow again. Something for nothing. Wave a magic wand. Printing money is waving a magic wand. It doesn't do what businesses do and what government also needs to do. Look down, where are you really making money? What's working? Where are you growing? And where are you not? And where's all that big, fat, juicy overhead that you can probably cut in half and never miss, because it actually does more harm than good.
So we've talked about what the United States should do, but what do you think inevitably will happen, though? Like in terms of a forecast, do you think we will turn it around, though?
Yeah, only because we're forced to. Like I
Mm-hmm.
say, somebody said, yeah, World War II, the U.S. always does the right thing after they've tried everything else. That's true of everybody. Okay, nobody wants to do the hard way, the hard work, step by step, progress by progress. Make your mistakes, admit them, and correct them, and move on. Okay, that's what people want it to happen magically. That's why when the government just started printing money, everybody's like, well, it sounds kind of hokey, but they've been doing it for 15 years now and the economy's better and I'm telling you, the stock market's way higher than it would have been naturally. Okay. Double at least. Okay. Everybody's gotten a free lunch from that. So you have to first take the free lunch away to wake people up. That happens only in a downturn. And the only reason we get in a downturn is because we so overstimulated that we created this inflation and this problem, and now we have to tighten. They've already tightened the most in 40 years.
Mm-hmm.
It just have to wait. I'm not going to make any judgments on where the economy's really at until the end of the first quarter of next year. And I'm betting we're going to already be in a recession. And whatever the government's going to do now, a quarter point in late September, another 50 basis points in November, and another quarter point December isn't going to make much difference, okay, in this thing that's already moving forward. And these rate cuts are going to impact for a year and a half out at least, continue to, and that's into early to mid next year. So I think the die's already cast. It's just a matter of it hitting, and then we get the reactions. But again, recessions are not the enemies. If you have healthy booms, you'll have healthier, less dramatic recession. We had the most debt-ridden, most bubble-ridden boom in all of history. I can't even compare this to the Roaring '20s or the 20 to 35 bubble boom and bubble. Can't even compare these to this. So the bubble has to burst. And you can't keep a bubble going forever because it takes more and more to get less and less. The law of diminishing returns is what will kill any bubble. No bubble can go on forever. And this one's already gone 2.5 times the typical bubble, particularly stock bubbles in modern history. Already gone 2.5 times as long. So this is already ending because it went to extreme, and that created the 9% inflation. And if they stimulate again, that inflation is going to come right back. That inflation was totally created by the stimulus. I show long-term inflations caused by workforce injury, which is because of the high cost of bringing a new virgin person into the workforce and economy. All the investments by companies to create an office and technology to that person, for the parents to raise them up till that point, which is $300,000 a kid on average for the average parent, okay? And governments, again, to subsidize until people become productive. People are a liability, an investment is a better way to call it, until they enter the workforce. And even that, it takes 2.5 years, I've found, 2.5 year lag before they start to produce more than they cost the economy and create booms and busts on a generational wave, which I can predict over the rest of any of our lifetimes in any major country in the world, including emerging countries, which I just use workforce because they're not as dynamically distributed in high and low incomes and stuff. But anyway, even in emerging countries, I can tell you economy's going to fail. China is going to go down and slow no matter what anybody does. And they're doing all the wrong things. Overbuilding. They got 22% empty homes. What would our economy be if 22% of offices and homes were empty? We would be in a depression, guaranteed. China, since they control their economy and just tell businesses, just keep building this stuff for nobody. We'll cover your back. We'll cover the economy. Well, now they're having to cut back because they have more than twice the debt of other emerging countries and almost as much as a developed country when they don't have the standard of living of a developed country. They're at 19,000 GDP per capita versus our 70,000. That's how second world, they're no longer in third world. They are a second world country spending and acting and borrowing like a first world country. And China is the first to be cutting back here. And China's going to have the biggest debt crisis in the world, not the US or Europe.
So with all this in mind, like if you're an average person with like $1 million net worth or like a couple $100,000 net worth, how do you prepare for something like this? Like what should the
It's
average
really
person do?
simple. And this is This is going against financial advisors who I like 80% of the time. This is a once in a lifetime event. I call it a great reset after a major bubble, and bubbles only come about every 90 years. Roaring 20s, and now is 90 years lag. And now we've had two bubbles instead of one because the second one's been artificial. So stretched it. You have to step away from every financial aspect. First of all, keep your job. If you don't own your own business, if you own your own business, do like me, be cutting costs, hunkering down, because the strongest businesses are going to survive. That's the whole purpose of recessions and downturns, is to make the strong stronger and weed out the weak. Okay, so the same thing. So the economy is going to have to get weak, and a lot of business is going to fail. Okay, well, you got to reinvest. And investors have to get out of the way. There's a simple place to go, and it's not cash. There's one investment that's already been proven when you have a strong deflationary downturn like 2008 to 9, already proven, even though they cut that short. Treasury bonds. 30-year Treasury bonds is the best single thing to put your money in because it leverages a slowdown or deflation. Long-term risk-free rates will go down while risk rates of corporations will go up because of failure. Well, the government's bonds are the ones that will not fail and stop because they won't let them. And those rates go down in 2008-9. 10-year Treasury bonds rate went to 4.4%, and the bonds appreciated almost 50%. This time, I'm estimating TLT, which is average of 10 and 30-year bonds, 20-year bond average, will go from 90 something today to 186, and that's just a little higher than it did in the COVID crisis when it went to 173. You could double your money sitting in the safest long-term bonds on earth, the safe haven, even though the U.S. has a deep recession like it did in 2008, only worse. Well, we're the best house in a bad neighborhood globally, as we were there. Everybody say, all the people who compete with me about a crash, Peter Schiff and all these people, are saying the dollar's going to crash. No, the dollar is a safe haven. Look at 2008. It's the one currency that went up. So we're the safe haven country with a safe haven currency. You put your money in our treasury bonds, 10 and 30 year, TLTs and ETF you can buy like a stock and sell in a second, the most liquid market on earth, most liquid thing to buy, and make money in a downturn. And then when the downturn's at its worst, you start doing the opposite. You go back into quality real estate and stocks because you're going to have another boom. We're going to have the millennial boom into 2037 before that starts to plateau. And so say 2026 or 27, 2037, you buy stocks at deep discounts and real estate on sale, the best time you'll ever see and have ever seen. And you make money again, but now you can't be in a diversified portfolio of stocks and sectors and different types of bonds because they're all going to go down except the safe haven bond, the AAA corporates, the AA, AAA corporates, and even better, the 10 and 30-year Treasury bonds. That's the safe haven, proven beyond a shadow of doubt in the 2008-9 downturn. And everybody else is to all the other bears are telling you to buy gold and silver. Good luck on that. Gold went down 45% at the worst in 2008. Not bad compared to stocks and other assets, but went down. It was not the safe haven and will not be again. I expect gold go from 2,500 a day back down to 1,000, 1,200 in this downturn. Wow. And then I'd be happy to buy gold long term, not because of its safe haven status, because the next big boom is going to be in India, like China, for the next several decades. And the Indians love gold, everything, more than any culture on earth. So I'll buy gold when it's back at 1,000, but gold is not going to do you well in this downturn. It will not protect you, as a lot of the hyperinflation crowd says. I'm in the deflation crowd. 2008 was deflation, but it was stopped. So 1930s was deflation. That deflation follows bubble booms because not just economy slows, but financial assets go down even more dramatically. And that shrinks the amount of total wealth in the world and shrinks all financial assets, all of them except as those safest safe haven bond. There is nowhere to hide. So Most financial advisors say, well, if you listen to a guy like Harry, well, maybe he's right. Well, we'll diversify you in these 3 or 4 or 5 different global stock sectors, and you'll be okay. You'll ride it out. No, not this time. Not in a 70 to 90% crash like 1929 to 32 or 1840 to 43. Those things are bubble bursts that annihilate almost all financial assets. There is no place to hide but the safe haven bond.
Hey guys, quick pause. Looking for a place to park your cash? Waiting for that big crash to happen? Well, at Moomoo, you can get 8.1% APY on uninvested cash. And on top of that, you get 15 free stocks. Be sure to take advantage of this special offer that we've been able to secure for you here exclusively on Capital Cosm. So what you've got to do, you deposit $100, you get 5 free stocks. You deposit $1,000, you get the remaining 10 free stocks. And then you get your 8.1% APY on uninvested cash when you open an account, enroll in Cash Sweep, and activate the coupon. So take advantage of this special offer that you won't find anywhere else for Capital Cosm viewers of this channel. Get 8.1% interest on your uninvested cash and 15 free stocks if that wasn't enough. Link is down below in the description box. Be sure to click it and redeem your offer. And now let's get back to the video. So is that what you're kind of forecasting? Is a 79% correction? Or
Yeah.
Not even correction, it's a crash.
Yeah, okay. And you know what that is? It's just back to 2012 in real estate and the early 2009 lows of stock. It's not going back and erasing the greatest boom in history, just the last artificial surge. And we should have peaked in 2007 anyway and gone more sideways until now, okay? Instead, they created the greatest stock bubble in history in one of the slowest economies in history otherwise by simply pouring in fake money. And it works short term, and it's worked for 14, 15 years. And again, I've been going, oh, yeah, but when does it burst? Because it keeps going. Well, 525 basis points say the highest probability of this thing bursting is over the next year. If it doesn't burst in the next year, I'm just going to shut up and go hide in the woods down here in Puerto Rico.
Well, so how do you control for the fact that more people have access to stock trading now today than they did at any other point in history? Doesn't that expand out the retail?
More people to feed the bubble, greater burst.
Mm-hmm.
And this has been a trend throughout history. But fundamentally, for companies to grow in mass, overall, you have to have a growing economy from consumers earning and spending more money, okay? And you got the biggest generation in history already programmed to spend less and save for retirement. They're at their peak saving for retirement now. And then they're going to start spending down those savings. Those savings have been the financial asset bubble has not just been all the stimulus, it's been the baby boomers. As of 2024, this very year is at the peak of their saving cycle, which is age 63 is when people have the highest savings and investments, okay? On the lag for the peak baby boomers, that's 2024. So not only are the demographic trends of spending been against, now the demographic trends of more money flowing into savings goes down as well, naturally. Again, you can't keep a bubble going forever on artificial stuff. There has to be real spending and or real savings. And ultimately, the spending is the most important because businesses have to see growing demand for their product to invest in the future and expand and make growing profits. You can't just go on. Savings only creates higher valuations in financial assets, and they'll just go till they get overvalued and they'll collapse because of that. So it's really the spending cycle that's the most important. And frankly, we're over the baby bust, okay? But again, the millennial boom is nothing like the 83 to 2007 boom in baby boomers relatively. So we have a milder boom from now into 2037, and then that just plateaus. It doesn't grow. It doesn't go down, but it doesn't grow. It just plateaus for decades. That's never happened before in history. So a lot of things are happening never before. The thing is, if you look at the right indicators, and there's only a few of them, spending on a 46 to 47-year lag, depending on the country, okay, or workforce growth in emerging countries will tell you where demographics are going. The technology cycle has 2 bubbles or 2 booms and busts every 45 years, so about every 22 and 20 and a half years. So, we had the first bubble into the late 90s, and this is the second technology bubble, which should have peaked in late 2019, early 2020. So now that technology innovation cycle joins the slowing demographic cycles. And again, sooner or later, how long can you just print money? And by the way, they just stopped doing that. They just shrank the balance sheet 1.8 trillion in the last few years and raised interest rates from 0 to 525. That's the death knell. It's just going to take 6 to 12 months to see how bad it hits. And I don't even know that. I'm just saying I'm getting the hell out of the way and telling everybody in my newsletter, get the hell out of the way and see what happens here, because it ain't going to go up more and it's not going to be pretty, whatever happens.
I see.
And they have tightened. They've already set the thing. Even if they reverse that, which they're going to start to do in September, extremely slowly, already by their own forecast, okay? That's going to take a year, year and a half to hit. So this is already set. Be out, be safe, and the safest place to be is in these 10 and 30-year Treasury bonds, or TLT is an ETF. You can buy that in a moment, sell it in a moment.
Gotcha. Well, Harry, we've covered pretty much the gambit of what I was hoping we would. Anything else you want to talk about that we didn't get a chance to get to? And also drop us where people can find you.
Yeah. Very simple. HarryDent.com. I have a free weekly newsletter. You're going to get a full page article and chart from me every week until you're compelled to get on my paid newsletter. And you can wait as long as you want. We got plenty of people doing both, okay? So free newsletter at HarryDent.com. You can't go wrong doing that. You can also sign up for my paid newsletter at HSDent.com. But get on our free newsletter. This is a good time to be listening to contrary people like me, including people like Peter Schiff. We may have different things about how this ends up in the thing, but anybody who has studied history and studied cycles agrees this is a bubble and it has to burst. No bubble in history has never not burst, and no bubble in history has been as long or as high as this bubble. That is just an absolute fact.
Gotcha. Well, guys, if you enjoyed this content, be sure to give us a like, comment, go Harry, go. If you agree with Harry's take, if you disagree, however, let me know. Really interested to get your thoughts. Tell me why you disagree, and subscribe to the channel if you haven't already. 75% of you guys who watch this content are not subscribed, so do me a good deal of work to have you subscribe, as it boosts our chances in the algorithm. So with all that said, you guys have a wonderful day. Harry, thank you so much for coming on, and we will catch you in the next episode.
Okay.